Hi, welcome. This is Hugh Massey from DNA Behaviour. Welcome today to our presentation on behaviourally smart compliance management. I'm also here with my off-sider, Chief Marketing Officer, Trip Rockwell. So what we're going to cover in today's webinar is how compliance risks can be by understanding human behaviour of the client, but also of the advisors and the other employees in the business. We're going to focus pretty heavily on investor suitability risk, which is a hotspot area for the regulators. And then we're going to look at how our processes can be weaved into a powerful know your client process. And whilst this has got a compliance focus, we also want to emphasize that this is actually a process that's great for the client in delivering a world-class client experience. So at the end of the day, both objectives are met. So what do we do as a business? DNA Behaviour is all about providing people insights and behavioural intelligence. And what we have historically done to achieve great results for our clients in both from the firm's perspective in delivering a great client experience, being compliant, but also for the investors, is the matching of the advisory team to the client behaviour, the goals and the solutions for a higher level of suitability. So we're all about matching people and then matching the people to the goals and the solutions that get offered. Why is human behaviour so important? All of us have a financial personality, and when we're dealing with money, so now you're seeing my screen. We just had a little technological blip. So we all have, as human beings, a financial personality, and we're all, which gets sparked off in dealing with money and heavily triggered by our human emotions. So we all, as people, have a relationship to money, whether we like it or not. Some of it's good, some of it's negative. But when we have emotional events that trigger our emotions, that will drive our financial personality traits much harder in terms of how we deal with money. And when I'm talking about emotions, there can be positive emotions which are around exuberance, but there are also negative emotions around things like fear. So what we've done at DNA Behaviour, and we've spent the last 15 years doing, is understanding each human being's financial personality, both the human being being the advisor and the client, in terms of how that drives decision making. So why is this important? And at the end of the day, the SEC and FINRA in the US, along with the DOL, are pushing down the line of building client-centered businesses. Now, my personal view is that every business should be client-centered and come from the place of the client. And in other countries where we've seen the client-centered push already been going on for even longer than in the United States, it's actually been positive for the advisors. Those who are left standing there with it have actually a much stronger business that's far more sustainable and have better results with the client. So, if you can build your business to be better with the client, then you're going to ultimately be far more successful. So what are some of the challenges that get faced and some of the problems out there? That as a human being, if you're as the advisor, you're only capable of truly engaging probably 40% of the population. And there will be 60% that you might have as clients or prospects that you will never really fully emotionally connect with because you've got a style and they've got a style. And it's hard to close that gap down. And it might well be that in your client base that you have quite a lot of what I call satisfied clients. You've done an okay job for them, but when they've got a real problem, they're going to go to somebody else. And so engagement's around having that really, really deep relationship. One of the things that we've seen is that 85% of complaints start with poor advisor-client communication. So how the advisor deals with problems and the client's reactions to those are really, really important. And communication is really the name of the game. If you as the advisor communicate badly with the client, particularly when a situation's heated or they've lost money or there's some problem, then that's what's going to trickle off the situation into a complaint. In advisory firms as well, and this is a big area of compliance these days, is the advisor the right fit for the firm? And you know, a rogue advisor isn't always a criminal, but you know, there can be bad behaviour, and it's understanding how the person might behave in pressure situations. And that could be the environment of the firm, it could be that the advisor has had a financial issue. And you know, what we've seen so far is a tick-the-box process when firms bring an advisor on board and they look at the background checks, but that's not looking at what the person might do in the future if faced with a pressured situation. So there are behavioural traits that we've researched that would help you as a firm identify which advisors could potentially be rogue and may need, you know, that doesn't mean they don't get hired, but because they could still be superstars, but they might need extra management and more awareness of what their situations are. Research also shows that advisors are only 40% accurate in identifying the client risk profile. So there's a huge gap there really in advisors understanding the behaviour of the client. A lot of advisors think that they are great with people, that they can pick the client well, and they may, you know, be able to make some good observations at times. But often, you know, the plan is long gone done when you start seeing the real client profile starting to come out. And you know, even at the starting process, you may not really know the client's profile. So the more that you can do in the KYC process up front to know the client, the better. You know, investor emotions can cause a lot of problems in decision making, and we've seen it, you know, with the do-it-yourself type investor, that it costs them 7.5% a year in performance. Advisor and investment manager biases are also important. So, you know, recognizing that their decision making style can can cause performance issues. So and also the other issue that's important to address is the firm culture as well. And so making sure that the culture from the top down, in terms of what the firm represents, the fee charging models, the way in which advisors are handled, the products are offered, the way in which people are incentivized to sell is all important in building a client-centered firm. So all of these aspects now have become increasingly important, and they're all related to human behavior, and the regulator is after more and more of them as time goes along. So, you know, summarizing all of this, the issues around suitability are not just with the client behavior. Clearly, having emotional clients is a big problem, and the clients will be emotional the greater there is a misalignment between their objective financial position and their more subjective emotional state. So that gap's got to be closed down. That's almost a given, but that's an area where advisors need to do far more work. The firm needs to have far stronger processes. And then, as we've talked about already, that, you know, you've got to manage the rogue advisor behaviour. So, you know, the advisors being better trained, to have better emotional intelligence, better skills in working with the clients, communicating with clients is all important. So, you know, rogue behaviour isn't just criminal behaviour; it is behaviour of the advisor that's not aligned to the client. And the firm itself's got to manage. You know, unfortunately, it's got to manage its own greed levels or the financial returns it wants to make, and, you know, properly balance out, you know, its revenue and remuneration models so that it's aligned to the client's interests. This is not all saying that, by implementing this is going to jettison the company's ability to be profitable. In fact, as I said before, the firms that do this well actually in the end are far more profitable. So that's really the challenge out there. Now, my big message around regulatory compliance, and a lot of people think that with Donald Trump becoming president that he's going to soften up, particularly on the DOL rule. He may well. But my argument to this is that technical regulatory compliance is one thing, but to some level, because it's principles-based, it's actually unclear. And the real issue is actually client complaints. And your challenge as an advisory firm and as advisors is ensuring that there are no complaints. Because in the financial services arena, once a client complains, whether the client's got a right to complain or not, the costs can be very high, and it's not dissimilar to the medical industry. Once a client or a patient complains, then it's all on. The lawyers get involved, and it becomes very, very messy. And what we've seen is that the number one area for focus for regulators at the moment is investor protection, and they're dealing with more and more complaints. And the SEC and FINRA in the last year have increased their resources by 20% to be dealing with these areas. And what we can see, though, in terms of regulations, being sort of technical regulations, the law is that you've got a compliance avalanche coming your way, and whilst it's not all here yet, it's not all being totally enforced. This is the way of the world in the future. But really, I would say, regardless of what the law says, is that you need to minimise complaints, because as I've sort of been, highlighting, the complaint really is the problem. And when the client makes the complaint, often the advisor doesn't know how to communicate properly in those environments. Emotions run high. Everybody has to get in the box and get their own set of lawyers, and the next thing you know is there's at least $250,000 of costs per advisory complaint, let alone the potential brand damage that gets done. And this actually can be terminal for some firms, and we've already seen the slapping on of some very huge, very big fines. So what we're advocating is that if the clients are better understood, there is a much deeper relationship developed with the client, they feel that their interests are being totally protected, then this is positive. And regardless of what the law says or Donald Trump seeks to do around the DOL rule, I think every advisor needs to be going down this track of building a far more engaging experience, and it will increase revenues, and also it's going to reduce the potential for costly complaints. And our objective as a firm is to help you have much higher levels of investor suitability, and we believe we can get that number up to 99.75%. And I'm not talking just about complaints there. The fact is, if you really look at the suitability levels at the moment, they're probably down at 40 to 50%, basically because the advisor doesn't understand the client, and a tick-the-box KYC process is being followed. So what do we do here to build the firm to being, delivering a superstar client service experience, but also be rock solid from a compliance perspective? It really all starts with the top. It comes down to the advisory firm culture, the remuneration charging model, the team culture. So I've mentioned some of these things. Then it's looking around the circle here, really at communication and how you connect with the clients and run meetings. We're working with a very large bank at the moment just on how they run their meetings and getting the bedside manner right in terms of the communication, because whilst that is good for the client experience, it's also good for compliance. Implementing a goals-based planning process that's behaviourally driven, and then there's the ongoing, behavioural monitoring of the solutions offered to the client's risk profile and to their behavioural style, and the ongoing coaching. Now, I'm not going to read out all of these elements in here, but rather than just to say that, what we're doing is helping firms build a compliance program, and the elements that relate to our solutions are contained in here. And so it's very, very detailed, and this goes right from ensuring you've got the right advisors on the platform that fit the organisational culture, that they're managed properly, their emotional intelligence is developed, to building, a strong KYC process, uncovering all of the objective and subjective elements, particularly the risk elements, for providing the right portfolios, building a goals-based planning process, and then having the monitoring systems, which also includes technology. And here in this slide here, and you're going to be given all these slides, so again, I'm not reading it all out, but based on best practices, research from all around the world, these are all the elements that are needed for a very strong KYC process. Now, the FINRA rules 2090 and 2111 deal very well with, in terms of specifics, with the first box here. So I presume that the US advisors are doing most of this pretty well, although I've seen some weaken it. I think the areas that are very, very important, that often get missed are the investment experience and knowledge. The background education of the person's is important to understand. Understanding their tax status. So, whilst some of this is done okay, a lot of the robos do this in part, where they're guessing. And I've seen even some bigger banks are doing some of this, where they're guessing the behaviour of the client based on demographics and sort of psychographic information, the actions of the person. That doesn't tell you all of it. But generally speaking, if you are doing this, which FINRA rules 2090 and 2111 require, then that's a good start. But those rules are fairly much silent, other than saying you need to understand the risk profile of the client. Well, that's fairly open and pretty much principles based. And so there are a lot of elements on the subjective side to understand the client emotions. And you can take, as I said, you can take a stand on the law and say, well, you don't need to do much in this area, and maybe you don't even need to. You could arguably say, well, I don't need to use profiling or psychometric instrument. But the fact is that you're leaving yourself open to complaints, because the idea of the psychometric instrument is to narrow this gap down of understanding the client in specifics. Because as I'll show you later in case studies, clients can have pretty similar backgrounds financially, but they will be very different as a human being and need to be managed very differently. And then it's a matter of how all this is weaved into a goals-based planning process, and that's what we will show you in the presentation today. So, our business model for KYC compliance is ensuring that the client participates in the process, having a discovery process that that the advisor is basically completing based on guessing what the client has said, or making assumptions about the client without the client actively participating in it, doesn't really work. And it doesn't work from two levels. It's not providing you with accurate and reliable information, which you can get from an objective process completed by the client, but also if the client doesn't participate, they will be far less likely to be engaged in the process, and later on when there's a problem, they are more likely to actually complain. And so the higher the level of client participation at every step of the planning process, the more likely that what you come up with in terms of the solution will be compliant, but also the client will be engaged in it and they'll signed off on it. And that is very, very important. So, encouraging higher levels of active client participation and advisor behavioural management of the client is the key to success here. Now, the regulators don't recommend specific approaches or tools or methodologies, and they never will. They adopt a much more of a principles-based approach, and that's all fine. But of course, the principles are open to interpretation, and that always gets challenged once there is a complaint. And I know that there are firms out there that refuse to implement very tight processes, and particularly in the around the psychometric or subjective side of understanding the client, because they're scared if they don't follow the process somewhere, and there is a complaint, it'll be worse for them. You know, you sort of, you're in trouble if you do and you're in trouble if you don't. But at the end of the day, the tighter the process that you have and that it's followed every time is really the course to safety. In terms of financial DNA, it is an extremely robust process in terms of know your client. We've had it reviewed by compliance departments and the regulators in various parts around the world. You know, and you know, in terms of what is prescribed out there as fit for purpose and best practices, we're top of the pops. We've had independent research done on our system as well in terms of its psychometric strength. So we're, you know, bringing to the table a pretty powerful solution that will work if used the right way. So what does financial DNA do? It is multidimensional in terms of the behavioral discovery. We look at the advisor-client communication. As I said to you before, that's a big area if, you know, in terms of triggering complaints if communication is poor. And also in getting the client to understand the solution offered. And if there's a mismatch there, you're going to have big problems. And then in terms of implementing a goals-based planning process, understanding client spending patterns. You know, if clients are high spenders, that will put more risk on the overall portfolio to have to perform to achieve a retirement goal. And so spending patterns are really important. So understanding whether your client is a spender or saver is really important. Then, you know, the next part is, you know, just understanding the risk profile and the behavioural biases. And so it's, you know, these areas here in the black circles is where we're different to any of the other risk profiling tools out there. And in fact, on that, we actually uncover far more elements of the risk profile. There are many, as I'm going to show you in this presentation. There are a number of specific elements that make up a risk profile, and that's what we measure, whereas a lot of instruments out there just ask 3 to 5 questions, some up to 20 questions, and give you a singular score that's applied in a singular way, and that actually doesn't work. And also, our starting point's different. We start with a person's natural instinctive behaviour because that's where they're going to revert to when they're under pressure. And so that is also the place where, you know, really the foundation for building a long-term portfolio. So, you know, the best practice is design the portfolio for the long term and then be reviewing, you know, short-term situational shifts, not the other way around. That's why it's important to understand the hardwired behaviour up front, because it gives you the long-term perspectives. So just putting this all in another way, you know, a lot of processes out there are good at uncovering the, you know, the investment dollars and how much money is required for achieving the goal. Two people can be the same in that respect, but then they're very different in terms of their behaviour and how they need to be managed. And they will have different investment behaviour risks, make decisions a different way, and need to be communicated with differently. So this is why financial DNA is very important. And, you know, just to sort of get to our psychometric strength and reinforce the point, you know, if the advisor is out there guessing as to who the client is, then, you know, research would say that they're likely to be right 40% of the time or near right 40% of the time. And I have done exercises in the past with advisors where I've given them a set of case facts, you know, 10 advisors or 20 advisors a set of case facts, and they will all be making different assumptions about the client's risk profile and come up with a different result. Well, I don't know how you can manage a firm and if you're the broker-dealer or the bank with the licensing, take responsibility for what your advisors do in that scenario. So what financial DNA will do with our validation is that it is 91% accurate and then and reliable, and if you follow the right processes in using the information, then you can achieve you know, even a much a higher level of investor suitability. It will never be perfect because that's life. Life isn't perfect, but you can get it pretty close. So in looking at your personality brain and the personality brains of your advisors and the clients, you know, the position we take and that we've taken for the last 15 years, and it's now been corroborated by a lot of other research from Nobel Prize winning professors and other luminaries out there. Basically, a person's decision making is 95% governed by their automatic, hardwired behaviour. And 5% it comes from more their conscious thinking. So what this is really getting at here is that your hardwired behaviour is very, very important to the decision making. It's the foundation. You can mask it. You can work on becoming more educated, building self-awareness to make more conscious choices, but it's really hard to control. And so this is where 95% of the decision-making style, and reality is where most people are comfortable, is in their natural DNA behaviour. The natural behaviour will be triggered off by emotions. So here are some positive and negative emotional stimuli that will trigger off the natural instinctive behaviour. And this is where you'll see, and this is really why I got to this place. When I was a financial advisor in Sydney, Australia, and in a way I still deal with a lot of people and clients, they can appear nice and even in the early meetings, but when they're under pressure, that's when you see the real person coming out. And so that's what then drives the cognitive biases. They're driven harder by the emotions, and this is what leads to the imperfect decision making, which is really what the world of behavioral finance is all about. The fact is that as human beings, we're not rational, we don't make perfect decisions. But that imperfect decision making can be predicted, and that's what financial DNA is designed to do. We want to understand what the person's long-term behavioral style is first, because that's going to be their based on their instinctive go-to pattern, and then look at the the behaviour gaps above and below the line, as to where they are situationally. And people all have different perceptions of the markets. They have different learned and life and educational experiences that might influence their thinking at a particular time. And there may also be cause to vary the portfolios because of client goals or financial capacity. But you do need to know their baseline point where they're going to go to under pressure. So this is a very detailed slide, but it's actually fundamental to understanding our system. And I have designed this to show you that there are many elements of risk that make up the risk profile. So the person's overall risk profile is down the bottom there. But it is a combination of all of these risk elements here. So the risk need is the risk required to meet a person's financial goals. That's really a mathematical calculation. We document that in our investment policy statement, and it would be determined from using a financial planning software that's goals-based. There's a person's risk capacity. That's their financial ability to endure the risks of portfolio losses. So to some degree, FINRA rules 2090 and 2111 are driving hard at ensuring that the advisors calculate the risk need and the capacity. Now, going to the softer side, the subjective side is, what's the person's risk propensity, their willingness to take risk, and their ability to live with losses. What's their emotional ability to live with losses? And actually, what we find is these two behaviours are actually quite different. We measure them separately, and what we're really getting at is what is the willingness of the person to jump off the cliff, but and make a choice, but how are they going to feel when it goes wrong? And then you've got the loss aversion thrown in there, which is pretty close to the risk tolerance, but we also measure this as well because it's very important. Is what is the likelihood that the client's going to maintain their investments in down markets and not crystallise the losses? So in essence, not panic when their emotions trigger them. So that's pretty similar to the risk tolerance, but they are these are different calculations. Then you want to know the client's risk composure, how they behave in a crisis. And we've built a tool called the Market Mood that enables you as the advisor, and the client can go in online as well, where you can simulate client reactions in different levels of the market moving up and down. And to see when they're feeling exuberant, what will they do? How do they need to be communicated with and related to? And if the market drops, what will they do? And of course, this is also a way of getting a gauge on the client's loss aversion. And then people have a perception of risk. they're making personal judgments all the time from what they read in the newspaper, what they think about the election results. But that's not necessarily a reflection of their personality. It's just what's coming from the gut. That can't be measured psychometrically, but it's still nevertheless important to understand what the client's perceptions might be, because they need to be managed. It's very interesting looking at historical research as to the influence of a president over the stock market in the year that they're elected, and generally through their term. And that's why I was pretty strong on telling people, regardless of what they think or feel about Donald Trump politically, this is not a political statement, but not to just go and sell your portfolio because he got elected as the president. Let's wait and see what he does. And then, it's important to understand what the person's actual risk preference is. What level of risk are they prepared to take, or what do they think they want to take? That is important. Now, our natural behaviour assessment here does not measure that, but our learned behaviour one does, because that's preference-based. So in our system, to capture these different risk elements, we're looking at the measurement of them from a person's automatic, instinctive, hardwired behaviour, the level 1 behaviour, the automatic decision-making biases, as Daniel Kahneman says, and then looking at the influence of learned behaviour. And there will often be a gap, and that's what needs to be managed. And all that information is taken to develop the risk profile that is going to be applied to the client's portfolio. And we advocate that then that is applied to various buckets of goals, depending on what amount of money the client needs to for basic living, and to sort of as a protection portfolio, versus what they need for capital appreciation to achieve their retirement goals, and what might be a strategic investing fund for having those things that might be fun in life. So this is what some extracts of our reports look like. Here we're measuring the risk propensity for taking chances, and then the risk tolerance. Mine, this is my scores. They both happen to be high here, but some people are high on this one and low on that one. Some are low here and high there, and that's why it's important to understand. We do split, take all of these scores and push them across 7 groupings based on population weighting. So we are in our system, which is important for compliance, able to identify those clients that should all be in cash, whether that's across their whole portfolio because they're more elderly or because they're extremely cautious, but also what component of the portfolio should go to that Group 1 bucket. Then importantly, we help you build an investment policy statement blending all of these items. So one important first step that we recommend is that the advisor understands what is the risk profile in the current portfolio the client has. So let's say you're dealing with a new prospect. What is the risk in the portfolio that they have? What is the mixture of equities and bonds, and alternatives that are in the portfolio? Because generally speaking, most clients are higher in terms of the current portfolio risk that they have than certainly who they are from a behavioural standpoint, and maybe what they need to be taking for their goals. And then you line that up against their risk need, which is what risk is needed to achieve the goals, the financial capacity, and then we start looking at the behavioural elements here. And at the end of the day, it's up to the advisor and the client through a robust discussion, which should be documented in planning notes, and in CRM systems and whatnot, but also in the IPS as to what level of risk will be taken, particularly for that core portfolio that's got to achieve or capital growth for retirement. And in here you can see that the individual's propensity to take risk emotionally or subjectively is actually higher than what they need to take to achieve their goals. So in conclusion, we can dial it down. So the starting point is to know or build the portfolio around what the client's risk need is, and then understanding the subjective factors. Now there will be some cases for variation here, because if the client was lower on their risk grouping, and say they were a category 3 or 4 down here, but they need to take more risk to achieve their goals, well, that's a gap, and you're going to have to manage a very emotional client along the way. And it might be that you do have to invest the client upwards. But it's got to be documented, and the client's got to be bought into it, and they've got to feel it as they go along. And this is where, in those cases, the advisor would need to keep very close to the client. So that's almost what we're saying in here is, you know, if you can invest the client based on their natural behaviour, which in just this case here would be group 4, then you'll be able to keep them emotionally comfortable, generally speaking. We don't suggest you move it more than one group up or one group down. You know, if they go up, then they could get emotional. If the market gets rocky and there are swings in there and they don't get it, and here you could have mismanaged expectations. Now, there will be cases where you've got to go further, but again, that's what I'm highlighting, needs a lot of documentation. So at the end of the day, the whole process here really is around, you know, aligning you know, what the client's goals are and what their emotions are, and coming up with a solution. So in this slide here, and this might be one to study afterwards a little bit, but I built some different case studies just to highlight how this can all go in terms of, you know, if you take Jack's son here, pretty aggressive food franchise entrepreneur. He's got a portfolio currently that is quite high and taking risk. His preference is to dial it down a little bit, you know, to achieve his goals, which are quite lofty. So he hasn't had all the liquidation events yet, but he's also, you know, in real life, he's a pretty ambitious man. You know, he wants to make money. His risk capacity to endure the risks of portfolio losses is sort of in the middle at the moment, and that's just simply for where he's at, and he hasn't had all the liquidity events. His risk group is 5 there. Loss aversion is pretty strong, so he's not going to lose his mind if there's a downward movement in the market. His learned behaviour is a little bit lower. So where do we land the plane? We've actually built the portfolio around the group 5 there, which is a little bit down here, you know, from his risk need. So you can see these numbers here, emotionally and financial capacity-wise. He needs to be a little bit lower than his risk need, at least to start with, but you can work it upwards. And this is really the conversation point that you've got to have on an ongoing basis with the client and to be monitoring. And the firm, you know, the firm's compliance systems, at the end of the day, to be robust in this area, really do need to be able to bring this information together. But that can be done fairly easily between, you know, technology platforms and using our systems. And Helen Jones is really a case of a client again. You know, she's a dinner party investor. She's gone and bought positions and you know, made choices based on what she's heard others doing. She's got a high need to achieve goals, but again, she's got a lower risk capacity, and she's really a lot more cautious. And so, you know, you need to dial her down. And in real life, she's a spender. So that's quite a hard client potentially to deal with there. Craig Moon became very wealthy from being a tech biz founder, actually a very cautious person. But again, you know, here he's had a liquidity event, so he doesn't need to take a lot of risk to achieve his goals. He's got high financial capacity, but you know, you keep the portfolio dialed down, and even though he's an entrepreneur, he doesn't need to take a lot of risk in the portfolio. In fact, it would scare him if he did. And then you've got your executive in here who's a bit of a do-it-yourself investor, so he's taking a lot of risk in his portfolio, but again, you know, does he need to do that to achieve his goals? No, and that's where we've dialed it down. So that's the process. And I'm just coming up to the end of the, you know, the presentation here. So what's important, you know, in building, you know, dealing with compliance, particularly when you've got a lot of advisors on the platform, is it can't just be a free-for-all out there in terms of what they do. And I realise that some of the advisors are 1099s, but if you're a broker-dealer type firm or got others licensed under you, you can't just let them all do what they want to do, and then you have to take the financial risk for it. And so, you know, what is that balance? And of course, the advisor is taking risk too, but there is a balance there. And I think what I'm advocating is having a structured system that everybody can work with, and then deal with each client uniquely within having the structured process. So, you know, one thing that's important in compliance management is to know whether you've got advisors on your books that are actually going to follow the know your client and firm processes, or are they just going to be, are they a structured person or are they an instinctive person? I think that's really important to know who you're managing. And if you've got instinctive people on your, on your book of advisors, then they might need heavier management and watching what they do, particularly if they're risk takers. Then it's about communication and ensuring that there is good communication between the clients and the advisors, that the clients understanding what they've signed up for, and also putting in processes to manage whether there's negative relationship energy between the advisor and the client, which could mean there's a source of complaints later on. So, there are indicators that you can put on put on in the business for managing the level of client engagement. Of course, and perhaps the easiest one to be monitoring is what's the structure of the plan and the portfolio against the risk profile of the client, ensuring that is right, and particularly when adjustments are made along the way, are they within firm policies, and are they reasonable adjustments to be making given the client's emotional zone. And then, of course, it's also important to look at who your advisors are from the perspective of the biases that they bring to the table. For example, I am a high risk taker, and so I would need to be managed if I'm in working as an advisor on a platform to ensure that I don't take too much risk with the client, so I'm not letting my blind spots get in the way of servicing the client. And a lot of this can be achieved, and what we encourage is it is achieved through technology, and it's about integrating a system like what we've got, or if you're using another system, integrating that to the CRM platform, the financial planning software, the investment management software, so that you can get a full picture of what every advisor is doing with every client, and building higher levels of alignment in the solutions offered, and a deeper level of continuous engagement. So I'm at the end of the webinar here. We are going to provide this webinar, the recording and the slides to you. We're also going to provide you with some extra resources as well, so that you can study this area. We've just written a paper on operational security risks, which is one dimension of compliance, particularly would be worthwhile looking at in terms of identifying whether the advisor is rogue or not. We are preparing another one at the moment on compliance management itself and the know your client processes. And we have a lot of resources here to really help you understand how human behavior fits in practically, can be used to build a much better compliance process. But as I said, we'll always reiterate, also make it a superb client experience. And if you want to follow our webinars more, my colleague Leon Morales will on November 30th at 1 o'clock present a goals-based planning presentation where we look at the practicalities of implementing a human behavioural approach using financial DNA in the goals-based planning process. Are there any questions? If any of you do have questions or want to have a discussion with us as to how a process like I've outlined today could be implemented in your business, I mean, it is a journey. It doesn't all have to be done overnight, but as I said, the compliance avalanche is coming, so it's better to be ahead of the game and start work implementing, regardless of what happens with the DOL rule. The world is going this way, and it's going client-centered. I believe your clients deserve it. You expect it when you go to another professional, whether it's a doctor, accountant, or lawyer, so why not give that to your clients as well?